Hello and welcome to my InvestEngine Stocks and Shares ISA portfolio update for September 2024. September has been observed to be a poor month for the markets historically, with this being referred to as the September effect. According to Investopedia, from 1928 through 2023, the S&P 500 index has averaged a decline during the month of September. In fact, September has been the worst performing month on average going back nearly a century. And September 2024 started out looking like it was going to be following that trend, with the S&P 500 dropping by nearly 5% in the first week of September, due to investors softening their optimism about AI in a broad market sell-off that was accelerated after tepid economic data. Of note, on the 3rd of September, Nvidia stock recorded the deepest ever single-day decline in market value for a US company, with a drop in its market capitalization of $279 billion. That is an incredible drop, and to put that into some sort of perspective, AstraZeneca, the largest company listed on the London Stock Exchange, has a market capitalization of around $244 billion. So Nvidia, in one day, dropped by more than the entire market cap of the largest UK company. That both emphasises the sheer scale of the drop, but also highlights that the UK stock market really is tiny compared to the US. However, despite this poor start to the markets in September, it actually ended up being a good month, with the S&P 500 on a 1-month chart being up by 3.78%. You can see that big dip at the start of the month, followed by a strong recovery in the second half of September. This was undoubtedly helped by the FOMC surprising the markets by announcing a 50 basis points cut in the interest rates on the 18th of September. At the start of the month, markets estimated about a 30% chance of this happening, with most expecting a 25 basis point cut. So it was a positive surprise. In theory, lower interest rates boost demand and therefore should stimulate the economy. So it is looking like September 2024 has avoided the September effect. Although as UK investors, we have not experienced this full recovery in our portfolios because the pound has continued to strengthen against the dollar. On a 1-month chart, we can see it is up by 1.95% and it now stands at £1 equals roughly $1.34. Although our portfolios will not be looking as healthy as they are for Americans, on a positive note, a strong pound means that we will get more out of our contributions as we get more dollars for every pound and thus greater buying power. But overall, as a long-term investor, I do not worry too much about the exchange rate either way. You can always put a positive spin on it if you're investing for 5 to 10 years plus. Now, jumping into the portfolio update, as always, I'll start off with my main InvestEngine DIY ETF portfolio and update you on the changes I've made and how the components are performing, before quickly going over the managed portfolio as well. To finish the video, I'll give you my thoughts on the portfolio going forward. Remember, these videos are not financial advice or a recommendation of what to invest in. Please always do your own research before making any investment decision. When investing, your capital is at risk and you may get back less than what you put in. Looking at the balance of my InvestEngine DIY portfolio, we can see it now stands at £22,995.44, which is slightly above the £22,859.85 it was at the end of August. So we can see the result of the strengthening pound in my portfolio here. Despite it being a strong month for US stocks, my portfolio has barely shifted. Turning to the portfolio page on InvestEngine, we can see on the maximum performance chart, my investment return figure now stands at plus £3,333.38, or 23.63%. Switching to the 1-month chart shows a return of plus £70.39 or minus 0.06%. This minus percentage figure sometimes happens due to InvestEngine's use of the time-weighted rate of return. I have had no further contributions this month because, as I mentioned in last month's update, I've now maxed out my ISA allowance this tax year with £13,500 in Trading 212, £2,500 in InvestEngine, and £4,000 into my lifetime ISA on Hargreaves Lansdown. However, the one dot here is when I actually made a big change to the portfolio and rebalanced it. I'd been thinking of removing the Xtrackers MSCI World Momentum ETF for a while now, and with the recovery this month, I thought rather than continuously waiting for the perfect time that may never come, it was best to just take the opportunity to remove the position now. I did this because Momentum has had a great run and it has been my best performing ETF, but it is a volatile factor and it can go down just as quickly as it goes up. You can see that my thinking has evolved from holding all factors in a portfolio put together when I first explored factor investing, to instead seeing the quality factor as a great core of a portfolio, but other factors such as value and momentum, due to their volatility and deviation from the market, they're better suited as satellite positions that can be tweaked in and out of the portfolio as a bit of an active play and a more hands-on approach. Like with all things, this is my personal thoughts and you may disagree. I want to make clear that my decision to remove XDEM was not because I believe a market crash is coming. I have no way of knowing. Besides, as you can see here, I've increased my allocation to quality, which contains a lot of the same stocks anyway, so that is hardly the change of someone preparing for a crash. My portfolio now breaks down as 35% GGRG, 35% XDEQ, 14% UC99, 8% EMIM, and 8% ISP6. So it is simplified, and I really do like the look of it. If you think of this portfolio in terms of the core satellite strategy I discussed in my last video, I would say I have a 70% weighting to the developed world quality as my core, and then satellite positions in US quality, emerging markets, and US small caps. With that change explained, I'll now scroll down to take a look at how all the ETFs have performed over the past month. First up, the Global Quality Factor ETFs, GGRG and XDEQ are down by £23.10 and £12.62 respectively, so pretty flat. Until we get a superior Global Quality Factor ETF, these two are the best options available for those wanting exposure to the quality factor, in my opinion of course. Next up is UC99, the USA Quality Factor ETF. My holding is up by £8.46. This one, unsurprisingly, due to its large allocation to Nvidia, took a big hit during the dip at the start of the month, but it has now recovered, and like with all my other ETFs in the portfolio, the returns would be better if it was not for the strengthening pound. Next up is EMIM, the Emerging Markets ETF, and my position is up by £91.50 or 4.49%. It has been a great month for emerging markets, with Chinese stocks in particular doing well after Beijing announced an economic stimulus package of $114 billion. It is great to see some positive movement in the emerging markets ETF after a period of comparatively underwhelming performance. Last in the portfolio is the iShares S&P Small Cap 600 ETF with the ticker ISP6. This one is surprisingly flat this month, with it being down by 56p. With rate cuts now officially in place and the direction of monetary policy changed, it will be interesting to see if small caps experience some gains in the coming months. They do remain very cheap from a price to earnings perspective. That's the 1 month performance of all my ETFs, but I'll now switch to the maximum view. The great thing about InvestEngine is the return figure that I showed at the start includes the realized gains from the previous ETFs I held and the dividends received. So that is why the sum of these ETF returns here do not equal the return I showed at the top. I'm really happy with how the portfolio is doing, and it's really nice to see green across the board. Now looking at the managed portfolio, it is up by 22.62% since the portfolio started on the 1st of November, and InvestEngine have done a very good job here. Over the past month it is up by 1.43%, and yet again InvestEngine's decision to use a GBP hedged S&P 500 ETF, which in the short term basically removes the impact of the strengthening pound against the dollar, has proved to be a good one. You can see that whilst most of the ETFs are pretty flat, the X-Trackers S&P 500 ETF that InvestEngine has picked is up by 2.17%. The rest of the ETFs have performed in line with what is expected, with some positions being similar or the same as in my DIY portfolio. You can really see that it is the hedged ETF doing all the heavy lifting here. Of course, if the pound weakens, the reverse will be true and the non-hedged ETFs will outperform, so it is swings and roundabouts. If you like the sound of having your investments managed for you and having a completely hands-off approach, then it may be worth looking into the IE managed service. They do have a very reasonable fee of 0.25%, and so far I am quite happy with their ETF selection and how it has performed. So that's the update, and to finish the video, I thought I'd quickly give an overview of the portfolio and my thoughts going forward. With the DIY portfolio now simplified to 5 positions, it is looking quite neat. I have no further plans at the moment, but I do hope that at some point I'm able to simplify the 2 global quality ETFs into one. At the moment I like holding both as they do work slightly differently, and in danger of sounding like a broken record to my regular viewers, I am holding out that an ETF provider will release an ETF that tracks the main MSCI World Quality Index. This has an exceptional track record, and I'd happily have an MSCI World Quality ETF as my sole core fund. Despite XDEQ having MSCI World Quality in its name, it unfortunately tracks the less impressive MSCI World Sector Neutral Quality Index. But it's still not bad, and alongside GGRG, it is probably the best bet we have as UK investors wanting a global quality ETF at the moment. The last thing to note is that as I cannot contribute to my ISAs anymore this tax year, I will be investing inside a GIA over on Trading 212 for the remainder of the year. I may also contribute to a SIP, but this will depend on what Rachel Reeves announces in her budget, and it will also depend on whether I have any extra income falling in the higher tax bracket, as that is when contributions to a SIP become more attractive. I'll keep an eye on things, and of course, keep you all updated. That is it for this video. Overall, I continue to be very happy with the portfolio, and I hope it is still interesting to watch these videos despite me not making any further contributions. Let me know how your portfolios are doing in the comments below, and if you enjoyed the video, please consider leaving a like, and I'll see you in the next one. As always, thank you for watching.